The Nasdaq just officially entered a market correction. Your investments are down, and today, Europe's most powerful central banker just made the outlook significantly worse. The Nasdaq closed Thursday down 2.38%, officially crossing the 10% decline threshold from its October high. That is the technical definition of a market correction. The S&P 500 fell 1.74% to 6,477. The Dow shed 469 points. Brent crude jumped nearly 6% to $108 a barrel. And then Christine Lagarde, the president of the European Central Bank, stepped to the microphone and said something that sent shockwaves through global markets. She warned that rate hikes are now on the table, not just in Europe. The OECD is now forecasting U.S. inflation at 4.2% this year, nearly double the Federal Reserve's own estimate of 2.7%. In this video, I am going to break down exactly what is happening, why Lagarde's words matter so much beyond Europe, and the one question every investor needs to answer right now. Is this correction a buying opportunity or the beginning of something much worse? The Nasdaq enters correction. What the numbers mean. Let me put today's numbers in plain context. A market correction is a 10% or greater decline from a recent high. The Nasdaq hit its peak on October 29th last year. Today it closed down 10.3% from that level. That is the official crossing of the correction threshold. The S&P 500 is not yet in correction territory, but it is close. It is approaching its November 2025 lows at 6,477. If it closes below that level, it will be trading at its lowest point since September. What drove today's sell-off? Three things hitting simultaneously. First, oil. Brent crude jumped 5.66% to settle at $108 a barrel. That reversal crushed Monday's optimism. The ceasefire hope that drove the Dow up 631 points on Monday has completely evaporated. Second, Trump issued a new warning to Iran. He posted on Truth Social telling Iranian negotiators to get serious and warning there would be no turning back before a new 5-day deadline. Markets read that as escalation, not de-escalation. Third, and this is the big one, the ECB. Lagarde's rate hike bomb and the OECD's shocking inflation forecast. Here is the moment that changed the tone of today's session. ECB President Christine Lagarde stepped up and said, clearly, that rate hikes are now a possibility. Not just in Europe. She warned equity markets were being too optimistic. She said if the Iran shock causes inflation to significantly overshoot the target, even temporarily, some measured adjustment of policy could be warranted. In central bank language, measured adjustment means a rate hike. The market reaction was immediate. Traders are now fully pricing 2 ECB rate hikes this year. The Nasdaq dropped 2.3% after her comments. Tech stocks, which are the most sensitive to rising interest rates, led the decline. Nvidia fell 3.7%. Alphabet dropped 3.5%. Now here is why Lagarde's warning matters beyond Europe. The OECD, the Organization for Economic Cooperation and Development, separately published a new inflation forecast for the United States. Their number, 4.2% inflation for 2026. The Federal Reserve's own estimate, published just last week, was 2.7%. That is not a rounding difference. That is a 1.5 percentage point gap. And if the OECD is closer to right than the Fed, the implications for interest rates are severe. Think about what 4.2% inflation with a weakening jobs market actually means. The Fed cannot cut rates because inflation is too high. It may even need to hike. Growth slows, unemployment rises. Stock valuations, which are priced on the assumption of future rate cuts, get re-rated lower. That is the stagflation trap. And today, both the OECD and the ECB confirmed that the risk of falling into it is higher than markets had priced. Correction or crash? The one number that answers everything. Now the question every investor is sitting with tonight, Is this correction a buying opportunity, or is this getting worse before it gets better? Let me give you the honest answer, which involves both sides. The case that this is a buying opportunity comes down to historical precedent. Since 1990, the S&P 500 has experienced an average intra-year decline of 14% in years where the index still finished positive. We are currently at roughly 8% from the January high. Historically, this is not unusual. Earnings growth for the S&P 500 is still projected at 17% for 2026. Corporate fundamentals have not broken. Corrections driven by external shocks, wars, energy crises, pandemics, have historically recovered once the shock passed. The case that this gets worse is equally clear. This is not a normal correction. The driver, the Strait of Hormuz closure, has not resolved. Iran is still charging ships $2 million per voyage. Trump's new 5-day deadline adds a fresh escalation risk this weekend. The OECD's 4.2% inflation forecast, if right, means rate cuts are dead for 2026, and rate hikes may be coming. Rate hikes on top of an oil shock is the most damaging combination possible for equity valuations. LPL Financial's chief technical strategist said it plainly today. Any sustainable market recovery will require meaningful progress toward a peace agreement and a reopening of the Strait of Hormuz. Until that happens, every rally is likely to be sold. Here is the single most important number for investors to watch right now: 6,477 on the S&P 500. That is today's close. It is also the November 2025 low. If the S&P closes convincingly below that level in the coming sessions, the next major support is not until around 6,200, which would represent a full 10% correction for the broader market. At that point, the buying opportunity argument becomes significantly stronger because much more of the bad news is already priced in. For now, the correction is real, the risks are real, and the single variable that resolves it is the same one it has been for 4 weeks: the Strait of Hormuz. The Nasdaq is officially in correction territory, down more than 10% from its October high. The S&P 500 is approaching its November lows. Brent crude jumped 6% on Thursday to $108. ECB President Lagarde warned equity markets are too optimistic and put rate hikes on the table. The OECD is forecasting U.S. inflation at 4.2%. 1.5 points above the Fed's own estimate. Traders are now pricing 2 ECB rate hikes this year. Is this a buying opportunity or something worse? History says corrections are normal and recoverable. The oil shock says this one has a specific catalyst that has not resolved. Watch the S&P 500's 6,477 level. And above all else, watch the Strait of Hormuz. The recovery starts when the oil shock ends. That has not happened yet. If this breakdown helped you understand what is driving markets lower and what to watch next, please like this video and subscribe to Global Finance Market News. We track global markets every single day so you do not have to. Hit the notification bell. You will want to know the moment this story breaks either way. Everything in this video is for educational and informational purposes only. This is not financial advice, and I am not a financial advisor. Please always do your own research before making any investment decisions. Past performance is never a guarantee of future results. Always consult a qualified financial professional before investing.